The best way to make money is honestly kind of boring. You just set this up once, keep putting money in, and over time, it just keeps growing. It's simple, it's consistent, and it is literally the laziest way that you can make a lot of money. But most people don't do it because investing feels way more complicated than it actually is. When you first look into it, it feels like you need a bunch of accounts, you need to understand the economy, and you need to pick the right stocks. And if you mess any of this up, you lose money. So most people just don't start. Or they tell themselves, I'll worry about this later. And then they never do. But the problem is, doing nothing is actually costing you money. And this is what I mean. That line right there shows the purchasing power of $1 over time. As you can see, it just keeps going down, which means if your money is just sitting there in a bank account and not being invested, you're quietly falling behind every single year. And I think a lot of people know they should be investing, they just don't know where to begin. So I'm going to try to help. In this video, I'm going to walk through the exact order I'd follow starting from $0, what accounts I'd actually open, what I'd invest in without overcomplicating it, and how I think about this long term. Nothing crazy, nothing complicated, just a simple way to start and actually stick with it. Before we get into it, I want to know, what's your biggest financial goal right now? Is it just starting to invest, or is it hitting a milestone like 10 or 100,000? For me personally, I want to buy a house in the next 3 to 5 years. Comment down below your answer. I'm really curious where you're all at. And just to be clear, this video is not financial advice. It's just what I would do starting from $0. So if I had to start over from $0 today, I wouldn't jump straight into stocks. I wouldn't try to pick investments. I wouldn't even open an account right away. If you have high interest debt like credit cards, that's the first thing I would focus on. Because if you're paying something like 20% interest, you're not beating that in the market on almost any investment. So even if you are investing, you're basically running uphill the entire time. Now, there is a little bit of nuance here that I apply in my own life. If it's really high, 7 to 10+%, I would pay that off first. If it's really low, like below 3%, I would recommend probably just investing. Anything in the middle, don't overthink whether you should pay it off or invest. My mindset would be this: get rid of the stuff that's clearly hurting you and don't overcomplicate the rest in the beginning. Now, before I build a full emergency fund, I'd make sure I can at least handle small emergencies, things like insurance deductibles and those random unexpected expenses. Even just a couple $1,000s can save you from starting over, because if something goes wrong and you have no buffer, you're either going to go into debt or you're going to start selling investments early, and that's how you're going to get stuck. If your job takes a 401k match, at this point, I would take it, no debate. Even if they match just a few percent, it's an instant 100% return on your money. And it's one of the few things in finance that's literally just free money. Everything else that says that is pretty much a scam. So at minimum, I would contribute enough to get the full match. From there, I would start building a more solid safety net, something like 3 to 6 months of expenses. This is what keeps you in the game long term, because life will happen. Unexpected stuff comes up, and when it does, you don't want your entire financial plan to fall apart. This is what gives you stability. Now, this is the point where investing gets really interesting and can get a lot more serious. I'd open up a Roth IRA at a brokerage like Vanguard, Schwab, or Fidelity. And if you don't know which brokerage to go with, then you can just pick your favorite color. If it's red, go to Vanguard, green, Fidelity, and blue, go to Schwab. It seriously takes like 10 minutes, and don't overthink the name. It's just a container for your investments. The main benefit is your money grows tax-free over time. And so this is where I would consistently start putting money in. There's an annual limit of $7,500 in the year 2026. So the government knows how overpowered this account is. Even if it's small, just contribute, because at this point, it's less about the amount and more about building the habit. Now, there's also something called an HSA, which is a health savings account. If you have access to one, please use it. It has very strong tax advantages. You put pre-tax money in, it grows tax-free, and you can withdraw it on qualified medical expenses tax-free whenever. If you don't use it for medical expenses, then it just becomes a traditional IRA that you pay income taxes on in retirement. Not everyone has access to it because it requires certain health insurance plans. So I would treat this as a bonus, not a requirement, but it's a great account to have. After that, once everything else is set up, I'd open a regular investing account, just a brokerage account. This is where any extra money will go. And at this point, you have your foundation set up, your account set up, and now you're just building over time. Feel free to screenshot this table that I put on the screen now. I'm not going to go over it again because we just covered it, but it's here for your reference. But once that's all in place, the real question becomes, what do you actually invest in? Now, this is where most people get stuck because it feels like you need to pick the right stocks, find the next big thing, or build some perfect portfolio. It's really easy to go down that rabbit hole and end up doing nothing. But the reality is, you don't need any of that to build wealth. If I had to keep this as simple as possible, I would just start with a total US market fund. Depending on your platform, you'll see different names like VTI, Schwab B, or FSKAX. They all do the same thing. They all track the United States market. So instead of trying to pick winners, you're buying a small piece of thousands of companies. As the market grows over time, you grow with it. And if you want to take it one step further, you can add some international exposure, something like 80% US total market and 20% international. Now, if that feels like too much already, you can just stick with the total US market. But if you want everything in one fund, you can use something like VT, which includes both US and international stocks. The goal here isn't to build the perfect portfolio, it's just to start. Most people don't mess this up by choosing the wrong investment. They mess it up by overthinking it too much and never actually investing. So instead of trying to time the market or wait for the perfect moment or constantly adjust things, I just invest consistently. Pick one of these paths, put money in regularly, and when things go down, don't panic. Think of it like everything's on sale. There's definitely more you can do over time, different strategies, different allocations, but that's a different level. If you're just starting, simple is better. And the reason I like this approach so much is because you're not trying to guess which company wins. You're just betting that over time, the economy grows. And historically, it has. So instead of trying to be right about one stock, you're just owning a small piece of everything. And if you're wondering how to actually buy this, it's way simpler than you think. I'll use Schwab as an example, but it's basically the same everywhere. You just want to open an account and deposit some money, then look for something that says trade. Search for one of the funds I listed, something like VTI or Schwab B. Now, when you get to this screen, it might look a little bit intimidating. I know it was for me my first time. You'll see things like market, limit, quantity. But honestly, when you're just starting, you don't need to worry about most of that. A basic market order is completely fine to get started. So now you just enter how much you want to invest and you hit buy. That's it. It's way simpler than it looks. Honestly, the hardest part isn't understanding this. It's actually just doing it for the first time. And once I understood that, everything got a lot simpler. Investing isn't about being smarter than everyone else. It's not about picking the perfect stocks or timing the market. It's about being consistent. And I know that sounds really boring, but boring is what actually works. I saw this Twitter meme and it is just hilarious. The people who win long term are just the ones who keep putting in money, don't panic when things go down, and they don't overcomplicate it. There's a book called The Simple Path to Wealth, which I'm going to link in the description. And the whole idea is very simple. You don't need to outsmart the market. You just need to be in it. Time in the market beats timing the market because the stock market goes up more than it goes down. The people who win aren't the smartest. They're just the ones who don't quit. Now, I think most people already know they should be investing. It's always kind of in the back of your mind, but there's always a reason to push it off. You say to yourself, I need to learn more first, or I don't make enough yet, or I'll start when things become more stable. The problem is, things never really feel stable. There's always something, whether it's money, the economy, life in general. And honestly, if I waited for the perfect time, this YouTube channel would have never been created. What ends up happening is people spend months, even years, thinking about investing and invest nothing. I want you to look at this chart. This is what your money can turn into depending on when you start. At 20, every dollar can turn into $88 in retirement, but by 30, it's only 23. That's still good, but that's only about a quarter of the multiplying power in just 10 years. And that's the part that most people miss. You don't need to be perfect to start because investing isn't about being smart. It's about time. And the person who starts earlier almost always wins. This is what people mean when they talk about compounding. The earlier you start, the more your money has time to grow, and then the more it begins to grow on itself. So instead of trying to do this perfectly, I want you to just focus on starting and not worrying about messing it up. Now, personal finance is called personal for a reason. your situation is going to be different than mine. Different income, different expenses. Maybe you have debt, maybe not. We all have different goals too. And that's where most advice online falls apart. It's either too generic or way too complicated to actually follow. So honestly, one of the best things you can do is take what I've shown you and plug it into something like ChatGPT or Claude and just say, here's my situation, my income, expenses, debt, goals, what should I do? Use it as a tool to organize your plan, not replace your thinking. And honestly, this matters even more if you're younger. If you're not 18 yet, you can get something called a custodial account with a parent. Even small amounts that early can turn into a lot later. Your biggest advantage is just learning about this now, but maybe look into that if you're interested in starting investing. Now, there are a few small mistakes that don't seem like a big deal at all, but quietly keep people stuck for years while investing. I want to break those down in one of my next videos. I really appreciate you for watching this one. I'm trying to make content that actually helps you with money, life, figuring things out in your 20s, because no one really gives you a playbook for this stuff. I've got more videos coming, like the biggest financial mistakes you can make and how I went from broke to 100K salary in a few years. So if you want to see those, subscribe, hit the notification bell, and I wish you a very nice day. Thanks for watching.